Hey everybody, this is Brant from Wolf on Wall Street Trade, soon to be the technicaltake.net, and it was a very ugly week this week, so a lot of the averages down between 2 and almost 4%. So what I want to do first, I just want to show you something from the subscribers blog. It's just a post just kind of laying out what I do, and you might want to pause the video to read it. So this is the daily wrap. It's the post I do at the end of every night. It's quite an extensive post, but if you just read the highlighted parts, I'm talking about forecasting the market, that I endeavor to build a case, not point out something that's already happened. This is why, because it gives you plenty of time to consider your actions that you might want to take. For instance, with the current head and shoulders tops that we're seeing everywhere, it has allowed you time. I'm not saying, oh, look, there's a head and shoulders top this week. I've been making the case for 6-7 weeks. So it gives you time to say, well, maybe I want to reduce some long equity exposure. Maybe I don't want to chase prices, chase rallies at this point. Like above 4,600 where everything failed. If you bought at 4,600, you'd be at a loss no matter what at this point. And at the very bottom, I just talk about all of the concepts that I use, all the indicators I use, the price interpretations that I use. They're all fractal by nature. That means if you're a swing trader, a day trader, a scalper, you're an investor, as long as you understand the concept, all you do is apply it to a different time frame chart and it works like a dream. So there's something to be said about building the cases, and if you watch my videos in series each week, what I do is I build the case, and if something changes, I'll change my mind, but nothing's changed. This case has been built. It's been very strong. So let's take a look at what we have. I'm going to go back to a couple brief clips from last weekend just to pick up. Okay, so this is a little clip from last week that I'm talking about what I expect coming into this past week. Okay, here it is. Let's talk about Friday's price action real quick and heading into next week. Friday obviously was ugly if you remember. So here we are, 2-minute chart, S&P 500. This is Thursday. That's that 4,500 level I talked about. Gap down below it. Friday morning over here, bearish flag intraday. We moved down some more, close right off market low. So this is not a good look at all going into next week. Same thing for the other averages, especially NASDAQ 100. Same thing, right? Okay, so the point is we just had some really ugly price action at the end of the prior week, suggesting that this past week was going to be ugly as well. At least it was going to start ugly as well. Here's another brief clip from last weekend's video. So what I'm looking for next, whether it happens next week or in the next few weeks, doesn't matter, is prices coming back down to these necklines and completing all of these bearish head and shoulder tops. So let's take a look and see what happened this week. Let me pull up some charts. This is the tech sector in the candlesticks and the semiconductors in blue. The semiconductors tend to be more economically sensitive, so they tend to lead the tech sector. So last week what I was pointing out was that they were already starting to lead lower into this week. And by the end of the week, you can see this is the tech sector's neckline. You can see the semis are already leading under that. So that was not pretty at all. Here is a 2-hour chart of the S&P 500 as of last weekend's video. We were right here. So look where we are now, just below the neckline. Exactly what we were looking for. S&P 500 was down 2.9% on the week. We now have a completed head and shoulders top with the left shoulder, the head, the right shoulder, and back down to the neckline. Here we have a 2-hour chart of the Dow Jones Industrial Average, a slanting, upward slanting head and shoulders. Here's the shoulder, head, right shoulder. There's the neckline. There's the breakdown below this week. So another average completed that neckline. Here's where we were as of last weekend's video. Here are the Dow Transports down 2.3%. There's the neckline. They have broken below the neckline. Here is the NASDAQ 100. I revised this neckline because of the volume. So look where we ended on Friday, right there at the neckline. Completed head and shoulders top. It just needs to break that neckline now. And down 3.3%, second worst performing index of the week. And here we have small cap IWM with an upward slanting head and shoulders top neckline. And look at this, man, breaks down. So this is a broken head and shoulders top. It's already breaking. So we've got every single major average, the S&P, Dow Industrials, Dow Transports, NASDAQ 100, small cap Russell 2000 all have head and shoulders tops in place. Some of them have broken down. And if we take a closer look at the price action in IWM or any of these, right, this is a 15-minute chart. That's the neckline. You just look at how price respects it. This just validates that neckline. Support there, kind of gets tangled up here, makes a brief little foray above there, fails, and then it becomes resistance over here. And towards the end of the week, we're just kind of drifting lower. Still looking ugly, but losing that downside momentum. As far as S&P sectors, we have 11 of them. Every single one of them was down this week in broad-based selling. So we're going to go through a few of those. Here's the lightly weighted material sector. Again, head and shoulders. There's the left side. Here's the head. There's the right side. There's the neckline. Here is the breakdown. So material sector down 4.1% on the week. The energy sector has been doing well with crude prices advancing since Saudi Arabia and Russia extended production cuts, but we can see recently a little toppy formation here in September, and it's not the same extent of head and shoulders that we see everywhere else, but it's breaking down too here, and down about 3% on the week. Here's the financial sector. It's not head and shoulders, but what it is a big descending triangle. It's really too big to be a consolidation pattern, but it is a bearish pattern. I'll show you why. So what you have basically is this level of support where buyers have been stepping in, but what we see on each advance is lower highs. So the buyers have less and less conviction. That makes this a bearish pattern, and it may bounce over here a little bit and then come down and break, but it's not a typical topping pattern, but it is a bearish price pattern. Financial sector down 3.35%, led by the regional banks, down almost 6%, 5.8% on the week. Here's the industrial sector, another head and shoulders top, another break over here. The sector was down 3.1% on the week. Are you seeing a theme here? Every average, most of the sectors. Here is the most influential S&P sector, technology, down 2.6% on the week. It is nearly there at that neckline. You can see a little bear flag over here. Here's the semiconductors. They tend to lead the tech sector. This is more of a complex head and shoulders top because we have multiple shoulders, multiple heads, multiple shoulders on the right side. We have price stopping right there, I think on Wednesday or Thursday, right at the neckline, breaking below it, back testing right into it, and finding resistance there, which gives that neckline extra validity. We'll take a closer look real quick. So 5-minute chart, there's a bearish consolidation, kind of breaks down, stops right there at the neckline. Next morning, gaps down, back tests into it right over here 3 times and fails. So again, it's giving extra validity to this neckline, how important it is. And look at the psychological level it's at, 3,400 whole number. The group was down 3.2% on the week. Another mega cap heavy sector is communications. This isn't as clean of a head and shoulders, but it's definitely a toppy pattern. We have a lower high over here, and it's heading down towards this neckline, as you can see, where there have been multiple instances of resistance here, support, support, support. So this is an important trend line. Let's see where it is about for XLC, somewhere about 64.60. The sector was down 2.8% this week, and then we have the mega cap heavy consumer discretionary. It's actually a cyclical sector, but because of huge mega caps like Amazon and Tesla, it acts like the mega cap secular growth sectors. And what did it do this week? Came down to the neckline, also lost 6.3%. I think it was the worst performing sector of the week. So the mega caps really got hit this week. As a matter of fact, here's the MGK Mega Cap Index. I just use that to keep things consistent. And what do you see there? Again, a head and shoulders top. Left shoulder, head, right shoulder. There's the neckline. Price came and ended right down at it on Friday. Underperformed the S&P Equal Weight Index by 100 basis points. So MGK was down almost 4%, 3.9%. And the S&P Equal Weight Index was down 2.9%. So underperformance in the mega caps as yields rose due to a hawkish Fed. Home builders down 3.45%. A little bit of a strange looking head and shoulders top, but it's a head and shoulders top. There's the neckline. You can see support, support, support. Here's the break, and we've got some bearish price action right under that. I'm guessing we probably get a back test of that former support trend line, the neckline, and it likely acts as resistance. Another area I've been talking about is the retail sector, and it was down 4.25% this week. Left shoulder, head, right shoulder, comes down to the neckline, breaks, back tests it right there, fails as former support becomes resistance. So again, I mean, everywhere we are looking, we are seeing head and shoulder tops that are either complete or have already started to break down. So when we go back to the very start of the video where I talk about why I like to build a case and how that helps my subscribers plan ahead and know what we're moving in towards, not just say, oh look, this week, look, there's a bunch of head and shoulders. No, we're talking about this 6-7 weeks ago as being a probability, and then as the information came in, it was like, well, is this probability higher or lower? Kept moving higher. So remember that old, some of you may not remember it, I'm showing my age, the A-Team. Remember Murdoch and his little saying, I love it when a plan comes together. I love it when a plan comes together. I just couldn't ask for more. I am so happy with our analysis and the way things have went. I am also very proud of our members. We've got new members that just signed up in the last week or two that are already like making money, and I use a little bit of an unconventional form of analysis, multiple time frames, cross asset analysis. It's not your typical technical analysis, and they're with me a week or two, they're already making money. I am really happy to hear that. That's not on me. That's just me giving them information and them applying that information. So very happy to hear that. If you understand how price behaves, you have a pretty good idea of what's coming next. So I want to show you one other thing. This was also from last weekend's video. I was talking about WTI crude futures. This is an excerpt from the video. Let me play it for you. So here we're looking at WTI crude oil futures on a 15-minute chart. Here is that bullish ascending triangle that I wrote about and told members about on Monday. Said, look, it's got 8% of upside, and guess when it breaks out? The very next day, Tuesday. Boom, there it is, heading higher, 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 higher. So I have two measured moves for crude. One is around 7.5%. It's kind of the more conservative, and one is up to about 9%. We're at about 3.25% already to a 10-month high. A lot of times when you get a measured move that's that big, 8 to 9%, something like that, you'll get like a bull flag or some kind of bullish consolidation about the midway point. So we're nearing that with a 3.25% in gains. So around 4% in gains. Start looking for a bullish consolidation. Okay, so remember that was last weekend. We hadn't quite hit the halfway mark. As of this week, from the breakout, we've already hit 4.45%, so that's basically half of that measured move. So what we look for next is a consolidation. It should be a bullish consolidation. I'm going to show you what happened in WTI crude this week. Here is the bullish consolidation I was talking about. Here's the breakout. Up here, we're already having hit halfway of the measured move, 4.5% of 9% measured move. And what do we get this past week? Exactly what I said, we get a bull flag. So this is a bullish consolidation. It is exactly where it should be. It's doing what it should be doing. So crude looks like it's probably going to have about another 4.5% once it breaks out from this neckline, at least 4.5%. I'll update the exact measured move for members during this week. In the meantime, what is next? So here's the daily chart, the S&P 500. This is basically our head and shoulders top, 50-day, 100-day. Price is really close to this neckline. In a post over the last week, I have reposted it. I tell you or show you what the most common things to happen are at this neckline, the different scenarios. And I think we're going to see one of them. So right now we have the strategic outlook. We have head and shoulders tops everywhere. Now we are looking for the tactical trade, the tactical entry. That all depends on what happens next. Ugly close on Friday, but we are losing momentum on the downside, and we're losing it right around these necklines. So what I'm kind of looking for is either some breaks below, some back tests, maybe some bearish consolidations. What would be even better, in my opinion, is a decent little bounce, not a bounce that's going to make another right shoulder, but a bounce maybe up to like 4,400, 4,425, something like that. These make killer short entries. It's part of a crash pattern I've never named, but I've seen it. in 1929. I've seen it in 1987. I saw it in 2000, 2007, early 2018, October 2018. It's just a really, really high probability crash pattern. I'm not looking for a market crash. I'm just saying that if we do get this, it's an excellent short entry. So right now we have the strategic view in place. We're looking for the tactical setups right now. So here's a 60-minute chart of the S&P 500. Here's that neckline. If we got something like a fill of this gap, right? Maybe even a little bit higher, that would be the kind of short setup that I would be looking for. So usually when we get this pattern, what we do is we get a break of the support line right here. That draws in new shorts. It creates a little short squeeze, and then there's just no momentum after that short squeeze, and you short it right up in here, and then prices break down. So that's one of the scenarios I'm looking for, but there's about 3 or 4 that I listed that are pretty popular, and then there's variations of those. So we'll just watch and see what happens. But what I do know is the market's very, very, very deeply oversold right now. And what you're looking at is the S&P 500 and the 13-week new high, new low ratio. It's a breadth oscillator, NYSE stocks in white. And what I've done is highlighted that white line under 10, which is oversold. But we got down into the ones this week, which is deeply oversold. Haven't been that deeply oversold since that pullback in March, which was about 9% in the S&P. The difference was in March, we had a pretty deep pullback, but we had very bullish consolidations. Now, we don't even have that deep of a pullback, but we have head and shoulder tops everywhere. But the point is, when you see these red areas, what happens more often than not is that they correlate with a market bounce off very deep oversold levels. You can see them here, you can see them here, you can see them here, off these very deep oversold levels over here, a little one over here, and here we are down here. So this is why I say when markets are this oversold, I don't initiate new short positions. I'll manage open short positions. I'll let those go and manage those, but I don't get into new short positions this oversold. Probabilities are just against you. And the shorts are all over this thing. Let me show you my most shorted index. So again, this is the S&P 500 in the area of that head and shoulders. This is my most shorted index. That is a massive short squeeze right there. But ever since that failure at 4,600 with the key reversal day and then the bearish breakaway gap right there, the shorts have been non-stop shorting this thing in my most shorted index. Now you might say, well, that's very bearish, shorts are smart money, but it's also contrarian. When you get this much short activity, it's setting up a short squeeze. So remember, right before the S&P crossed above 4,200, we had S&P futures, net spec, non-commercials, that means hedge funds, with the largest S&P short future position in history. S&P crossed above 4,200. They started covering, sent the S&P all the way up to 4,600, short covering. Then all these bearish funds that have been bearish since October and didn't get long until after they covered those shorts, they're buying into the top. This is a very contrarian signal in my opinion, and it's setting up the potential for a short squeeze that gives us that little kind of bounce that I was just talking about. And not that I trust Goldman Sachs, but Goldman Sachs Prime Service, they're a little bit different, and they've come away with the same outlook. And here's a chart I posted for members. Goldman Prime brokerage team supports the pain trade is now higher. This is due to a huge pickup in short selling, which I just showed you there. You can see it here on their chart. Short selling I've highlighted in red. Over here I've highlighted in red. So not that the shorts are going to be wrong, but it's all about timing. So I think in the meantime we could get a pretty good short squeeze that gives us that tactical short entry that we are looking for to sell into price strength. What's really most important though is what happens with yields, because higher yields, that's what's crushed the market this week. So we're going to take a quick look at that before we wrap up this video. You might have to listen to this a couple times if you're not familiar with this concept, but what you're looking at is NASDAQ futures and the candlesticks, and you're looking at the 10-year Treasury future in this magenta line. Now, the NASDAQ, especially the mega caps, have had a very strong inverse relationship with yields. Yields move opposite of treasury prices, so we can just use treasuries. And what I've been saying quite a few occasions is that Yields have been moving higher. The NASDAQ had been ignoring it, and it can't do that for long, and it will catch down. I'll show you an example. So here's an example of the NASDAQ rallying, but yields are not coming down. So it's pulling the NASDAQ lower. We come all the way down, all the way through this. Over here, we get these right shoulder rallies, right, in the major averages. But look what's happening with Treasury futures. That means yields are going higher. And what I've been saying is this relationship is not going to last long. The NASDAQ is going to catch down. And look what it has been doing since. It's been catching down. However, on Friday, I'm looking at 3C charts of index futures, Treasury futures. And this is mostly in the 5, 10, 30-year tenors. Not so much at the 2-year yet. But what I saw was something interesting. So this is 10-year Treasury futures, and the blue line is 3C. You can see 3C leading Treasury futures lower. That means yields are going higher, stocks are going lower. But as we come into this week, look at this positive divergence, a relative positive divergence into Thursday's lows, and by Friday it's leading higher. This suggests to me that next week we could see yields come down. That would also help stocks get a little bounce or hold at these necklines, maybe get that short, quick little bounce that sets up an awesome short trade. And if we look, like I said, multiple time frame analysis, we already looked at the big picture of how yields are really affecting or going to be affecting the market more in a negative way, but also we look at the short term too. And from the short-term perspective, what you see is Thursday here, NASDAQ is moving lower with treasuries. That means it's moving inversely with yields. Yields are going higher, NASDAQ's moving lower. But over here, look, treasuries are starting to lead higher. That means yields are pulling back. So if that keeps on going on into the first half of next week or so, that's going to give some support to stocks as well. Also, one of my favorite leading indicators, as long as you know the caveats, to using it is high yield credit, because it's a window into what institutional money's doing. And this is S&P 500 on a 2-minute chart and HYG, very deep liquid high yield credit product. What I pointed out on Thursday, even though it looks very minor, before 2 o'clock we could see that credit was starting to lead the market lower. It led it all the way lower into the close. But look at what happened on Friday. So S&P makes a lower low intraday on Friday here, a lower low intraday Friday on here. But look what high yield credit is doing. It is making higher lows, so it is positively diverging as yields are starting to come down a little bit. This is also the first sign of some constructive action that suggests that these necklines act as kind of magnets for price. And if they do, or we get a consolidation or a bounce, I'd expect it to be maybe a week, maybe 2 weeks or so, but that sets up our tactical trades. Our strategic outlook, our strategic view over the last 6-7 weeks that we've been building has worked perfectly. Head and shoulders in every single major average in most of the S&P sectors and a lot of other groups as well. So now we're looking for the tactical trade, how to take advantage of that and get involved in a timely fashion, but also at the best price with the least risk. And that is what we'll be doing next week. So if you haven't subscribed and you're interested in subscribing, you can still subscribe to my current, which will soon be my old website, Wolf on Wall Street Trade. Link is in the video description, but we are moving to the Technical Take. You can check out that website. You can check out the front page and everything, the technicaltake.net, also link that. That's where we're going to have a whole bunch of new features, our chat room just for members, no spam, no public stuff, just professionals. And we have quite a few professionals that are trading with us. So everybody have a fantastic weekend. And members, I'll see you Monday morning.